All right, let's talk about something exciting, taking your first step into the world of investing. You've worked hard, you've saved up $1,000, and now you're thinking, what's next? How do I make this money work for me? It's a fantastic question, and you've come to the right place. Before we even think about where to put the money, we need to talk about mindset. Investing can seem intimidating with all the charts, jargon, and fast-talking experts on TV, but here's the secret. For beginners, the best approach is often the simplest. We're not trying to get rich overnight. We're playing the long game. Our goal is to plant a financial tree today that will provide shade and fruit for years to come. So, take a deep breath. Forget the pressure to become a stock-picking genius. Our strategy is built on patience, consistency, and understanding what we're investing in. The first and most crucial step is to get your financial house in order. Think of it like building a house. You wouldn't put up the walls before laying a solid foundation, right? Investing is no different. So, what does that foundation look like? First, high-interest debt. I'm talking about credit card debt, personal loans, anything with an interest rate that makes your eyes water. If you're paying 20% interest on a credit card, paying that off is a guaranteed 20% return on your money. No investment in the world can reliably promise you that. So, before you invest that $1,000, ask yourself if you have any of this bad debt. If you do, using that $1,000 to attack it is the smartest financial move you can make. Second, an emergency fund. Life is unpredictable. Your car might break down, you might have an unexpected medical bill, or your pet might need to see the vet. An emergency fund is your financial safety net. It's cash that's easily accessible, not invested, to cover 3 to 6 months of essential living expenses. If you don't have this safety net in place, any market downturn could force you to sell your investments at the worst possible time just to cover an emergency. So, if your emergency fund isn't quite there yet, consider putting this $1,000 towards it. It's the ultimate peace of mind. Once your high-interest debt is gone and your emergency fund is healthy, you are officially ready to invest. Congratulations, this is a huge milestone. Now, where do we put this $1,000? For a beginner, I am a huge advocate for diversification and simplicity. We don't want to put all our eggs in one basket. Buying individual stocks can be risky and requires a ton of research. Instead, we're going to buy a piece of the entire market. How? Through exchange-traded funds or ETFs. Think of an ETF as a basket that holds hundreds or even thousands of different stocks. When you buy one share of the ETF, you're buying a tiny slice of all the companies in that basket. This gives you instant diversification. If 1 or 2 companies in the basket have a bad year, it's balanced out by the hundreds of others that are doing well. This approach dramatically reduces your risk compared to picking just a few individual stocks. It's the perfect starting point for a beginner. So, which ETFs should we look at? My strategy for this first $1,000 is to split it into 2 or 3 core funds. This gives us broad exposure to the market. Let's break it down. First, the core of our portfolio. I would allocate the biggest chunk, say $600, to a broad market U.S. stock index ETF. A great example is an S&P 500 ETF. The S&P 500 tracks the 500 largest publicly traded companies in the United States. Think Apple, Microsoft, Amazon, the giants of the economy. By buying an S&P 500 ETF, you're essentially betting on the long-term growth of the American economy. Historically, this has been a very good bet. This fund will be the engine of our portfolio's growth over the long term. Next, we want to look beyond the U.S. The global economy is vast and full of opportunities. So, I would take the next chunk, let's say $300, and invest it in an international stock index ETF. This fund would hold stocks from developed and emerging markets all over the world: Europe, Japan, China, and more. This adds another layer of diversification. Sometimes the U.S. market might be flat, while international markets are growing, and vice versa. This global exposure helps smooth out our returns and captures growth wherever it happens. Now, we have $100 left. What do we do with it? This is where you have a little flexibility. One solid option is to add some bonds. A total bond market ETF can provide stability to your portfolio. When stocks go down, bonds often hold their value or even go up. They're like the shock absorbers for your portfolio. Allocating this last $100 to a bond ETF can help reduce overall volatility, which is great for your peace of mind, especially when you're just starting out and getting used to the market's ups and downs. Another option for that last $100, if you have a slightly higher risk tolerance, is to invest in a sector-specific ETF that you believe in for the long term. Maybe it's technology, healthcare, or clean energy. This allows you to put a small amount of money behind a trend you're passionate about without betting the whole farm. Just remember, this is the most speculative part of the portfolio, so keep it small. For most beginners, the bond option is the more prudent choice. So, to recap the strategy, $600 in a U.S. total market or S&P 500 ETF, $300 in an international stock ETF, and $100 in a total bond market ETF. This creates a simple, globally diversified, and balanced portfolio. It's a set-it-and-forget-it approach that is perfect for beginners. Now, how do you actually do this? You'll need to open a brokerage account. There are many great low-cost options out there today, like Fidelity, Vanguard, or Charles Schwab. Many have no account minimums and offer commission-free trading on ETFs, which is perfect for us. The sign-up process is straightforward, usually taking just a few minutes online. Once your account is open and you've transferred your $1,000, you simply search for the ticker symbols of the ETFs we discussed and place your buy orders. But the journey doesn't end after you invest that first $1,000. In fact, it's just the beginning. The real power of investing comes from consistency. The most important thing you can do now is to create a habit of investing regularly. Even if it's just $50 or $100 a month, set up automatic transfers from your bank account to your brokerage account. This is a concept called dollar cost averaging. When you invest a fixed amount of money regularly, you buy more shares when prices are low and fewer shares when prices are high. This removes the emotion and guesswork of trying to time the market, which, by the way, is nearly impossible to do consistently. By automating your investments, you're paying yourself first and ensuring that your financial tree is continuously watered and nurtured. Over time, thanks to the magic of compound growth, these small, regular contributions can grow into a substantial sum. One final piece of advice: tune out the noise. The financial news cycle is designed to create urgency and fear. The market will go up and the market will go down. There will be days, weeks, or even months when your portfolio is in the red. This is normal. It's part of the process. The worst thing you can do during a downturn is panic and sell. Remember our mindset from the beginning. We are long-term investors. Your job is to stick to the plan, keep investing regularly, and trust in the process. Look at your portfolio once a quarter, not every day. Let it grow. Investing your first $1,000 is an incredible step towards building wealth and securing your financial independence. It's less about the specific amount and more about starting the habit and building the right foundation. This strategy gives you a simple, diversified, and powerful way to begin your journey. Thank you so much for spending this time with me today. I hope this breakdown was helpful and made the idea of investing a lot less scary. If you found value in this video, please give it a thumbs up. It really helps the channel. And be sure to subscribe and hit that notification bell so you don't miss our future videos. What are your plans for your first investment? Let me know in the comments below. See you next time.